Want to get paid just for owning stocks? That's the power of dividend investing. It's one of the simplest ways to earn passive income. And yes, it's as good as it sounds. Let's break it down. What is dividend investing? Dividend investing is a strategy where you invest in companies that pay out a portion of their profits to shareholders, called dividends. These payments are typically made quarterly and can be used as income or reinvested to buy more shares. For example, if you own 100 shares of a company that pays $1 per share, that's $100 a year just for holding the stock. Why dividends matter? Dividends aren't just free money though. They're also a sign of a company's financial health. Many dividend-paying companies are well established, stable, and have a long track record of profitability. This means that in addition to receiving dividends, you also have the opportunity to gain cash through growth in the stock price. Over time, reinvesting dividends can lead to compound growth, where your money earns more money, which earns even more money. This is how some investors build real wealth without ever selling their shares. Before we dive deeper into examples of how dividends can make you richer, let's discuss a few key terms and dates you need to know. The most important term to understand is dividend yield. Dividend yield shows how much money you earn from dividends compared to the stock's price. You find it by dividing the yearly dividend by the stock price. For example, if a $100 stock pays $3 a year per share, the yield is 3%. As for important dates, two key dates matter the most when it comes to dividend investing. The first is the ex-dividend date. This is the cutoff date to qualify for the next dividend. If you buy a stock on or after the X date, you won't receive that upcoming payment. The second is the payment date. This is when the company actually sends the dividend to shareholders, either as cash or reinvested shares, based on the investor's preference. As an investor, you will be able to see the dividend yield as well as the ex-dividend and payment date on most stock trading apps and financial websites. Now that we know what the dividend strategy is, as well as the key information and dates to look out for, let's walk through an example. Imagine Sarah buys 200 shares of a company called Blue Wave Energy at $50 per share. Blue Wave pays an annual dividend of $2 per share, split into 4 quarterly payments of 50 cents per share. That $2 annual dividend divided by the $50 stock price equals a dividend yield of 4%. If the ex-dividend date is March 14th, Sarah must own her shares before this date to get the dividend. She bought in February and selected to receive any dividends in cash, so she's all set. Because the payment date is April 1st, Sarah receives $100 straight into her brokerage account that day, just for holding 200 shares of Blue Wave Energy. Now let's look at an example in which instead of taking the $100 as cash, Sarah chooses to reinvest it into Blue Wave stock quarterly. At $50 per share, she uses her first $100 dividend to buy 2 extra shares, raising her total to 202 shares. Doing this instead increases her future dividend payments without adding new money and can turn modest dividend payouts into a serious income stream. Let's see how. Because she now owns 202 shares, her next quarterly payment grows to $101. She reinvests that, buying another 2 shares, bringing her to 204 shares. In the following quarter, her dividends rise again, enough for another 2 shares, totaling 206 shares. By the end of the next 4 quarters, after multiple rounds of reinvestment, Sarah owns 208 shares instead of just 200. Even without adding new money to buy additional shares, Sarah's annual dividend income grows each year simply because she reinvests her payouts. If Blue Wave increases its dividend or stock price over time, her compounding accelerates even more. This is the snowball effect of dividend investing. Your dividends buy more shares, which produce more dividends, which buy even more shares. Now that you understand how dividends work, What are some of the most popular dividend investments? First are Dividend Aristocrats. These are individual companies that have increased their dividends for 25 plus years. Second are REITs, also known as real estate investment trusts. REITs can be bought just like stocks and allow investors to get paid high dividends from rental income. And third are Dividend ETFs, which are investment funds that focus on investing in a basket of stocks that pay dividends. These dividend investments can be great for both beginners and experienced investors. Now that you know everything there is to dividend investing, it's time to put this investment strategy to work. Remember to pick reliable dividend-paying stocks, REITs, or ETFs. Reinvest your dividends automatically and stay consistent and think long-term. As you build your dividend empire, keep in mind dividend investing isn't about getting rich quick. It's about building a growing income stream over time. Hit that like button if you learned something new, subscribe for more beginner-friendly investing videos, and drop a comment if you have any questions.